Big bank shares are taking a breather today after that big surge yesterday. Same goes for the broader market. And this is even as bond yields continue to deflate a little bit, with the 10-year back around 4.6% today. Are investors soothed by what they heard from Trump's Treasury pick, Scott Bessent? Let's turn back to that question now. Matt Miskin joins us. He's the co-chief investment strategist at John Hancock Investment Management. And back for more, Dan Clifton of Strategas and PGIM's Tom Porcelli. Welcome back, or welcome to all of you. Matthew, let's hear from you. What do you think?
I love hearing no new taxes. Basically, that was the overarching theme I heard. And really what we're seeing is the Midwest is booming. We're seeing small business optimism surge. The U.S. economy is reaccelerating. But the old playbook, macro playbook of how to play this has changed. Small caps used to be the best way to play a reacceleration in the economy. We don't see that right now. Small caps, the Russell 2000, 40% of the companies don't make money. What they would prefer is actually low interest rates and capital given to them instead of making the profits. Mid-cap is the new small cap. What we are seeing is the profitability is in mid-cap. We're starting to see the relative strength improve in mid-cap. It's more industrials building out the Midwest, seeing this onshoring, this CapEx that's going to be coming through the economy. And it's cheap. It's got a valuation buffer relative to the high-flying growth names. So we're playing mid-caps into 2025.
I love the passion. Just a follow-up as well on what you said. No new taxes, read my lips. That was the message. Is there anything on the deficit, on Treasury issuance, on interest rates, which goes back to your point about the Russells, on tariffs? I mean, anything there? So, yeah, great, no new taxes, but anything on the tariff front that concerned you?
Yeah, at the end of the day, we want to have more U.S. revenue exposure than anywhere else in the world. If you actually look at global equities over the last decade, the best way to have invested is by looking at the companies and where they're focused on their business, where the revenues come from. You want to be U.S. focused. Well, in large cap, 40% of the revenues are abroad, and they're global multinationals that are going to be struggling with the tariffs, frankly. You heard kind of the aerospace industry constituents saying, hey, this is something we're watching for. But if you're down in cap, you're much more U.S. focused. Nearly 80 to 90% of the company's revenues are U.S. domiciled. In our view, that's going to help. Yep, there's inflation issues. Yep, there is a deficit that we're going to have to deal with. We've got to be careful with interest rates. But higher rates might mean actually better things for banks. More cyclicals. We might actually see M&A come back with deregulation. So financials might be coming back here into 2025. That's an overweight as you go down in market capitalization. Again, something to think about in terms of where you position in a portfolio.
That's interesting. And Tom, how are you guys modeling it out for the year? Did anything that you just heard kind of change that? I mean, I know you said you were keenly listening for what might be coming or not on tariffs.
Right. No, I think nothing that he said today is a surprise. In fact, if anything, I think the bigger news today was probably not him. It was probably Waller, who made those comments earlier about, sort of the potential for cuts even in the first half of the year. I think that's really what got the market moving. But in terms of Bessent, I think it was, for us, sort of very status quo, which is to say a good thing from an economic perspective. I mean, Trump was handed a really nice economic backdrop. I think it's now just his job, sort of to perpetuate it.
What is in the model for you right now for this year? What is GDP? What does jobs look like?
Yeah, so we're looking at just north of 2% growth, so about 2.2% growth full year. I think the unemployment rate probably sort of stays roughly here. I think we have it drifting slightly higher. We do have inflation that continues to drift down as the year progresses, and so that actually should open up the possibility for the Fed to actually continue the process of cutting. I get it. They've stepped to the sidelines, which I think is the prudent thing to do. Let's just wait and see what Trump actually unfolds. But I still think that there is very much scope for the Fed to continue easing.
Dan, I saw you nodding there about Waller's comments. You thought those were significant, too?
Yeah, I think it's consistent with what we talked about the last time I was on your show. I mean, he's really arguing the idea that if we do tariffs on China, that they're not going to be inflationary and that there's still room for the Fed. And I think that's a very important point, because if the Fed gets Trump's policies wrong, we're going to end up in the same place we did in 2018 with them being overly tight. Listen to what Bessent said today. He said China's the problem. we're going to go after China. And he says the currency is going to adjust that will soften the blow. The yuan has already come down by about 4% since the election. That's good for about a 10% increase. So the markets are already pricing this in. And if you just pull that together with what Matt was just talking about, there's just too much focus on the negative side, and they're important, and we got to incorporate them. But if there is a cut in the tax rate for domestic manufacturers, as Bessent called today, the impact, a corporate tax rate cut, the impact of those tariffs are going to be less onerous, which is exactly what happened in 2018 overall. So you've got to look at the policies in totality. And my sense here is that this is a very well thought out plan from the Trump folks. They've been planning this for 4 years, and they're going to come out guns blazing on Monday once he gets sworn in at the inauguration.